Hi, I'm Samantha Mackay, and today I will be discussing the importance of financial statements to the business stakeholders and their part in the accounting framework. Here is an example of a trial balance. Can you ascertain whether the company is successful? Is it profitable? What is the value of the company to the owner or shareholder? Has it got liquidity issues? How does the results compare to the previous period? Does the business need to seek further investment? Why is it successful or unsuccessful? The trial balance is the summary of the general ledger account balances of the company. However, we are unable to answer at a glance the questions previously asked. The trial balance is not the most effective report to communicate or assess the business operation. While most of the information is available, it is not presented in a way that makes analysis easy. This is one important reason why we prepare financial statements in a format that allows the owner or stakeholders to assess the performance and financial position of the business. The output of an accounting system are the financial statements. Their objective is to clearly and correctly communicate a true and fair view of the financial status and be relied upon by the end users to base opinions. All financial reports are prepared and abide by the GAAP framework, and in Australia we have adopted the IFRS that ensures the reports are consistent and of the highest quality to allow for a true and fair view. There are 4 financial statements. They do have links to one another, and all 4 should be referred to when assessing and analysing the business results. The first one is the Statement of Comprehensive Income. Preparation is based upon the matching principle. It involves matching the income or revenue against the costs or expenses for the period. Below is the formula used to calculate the end result, either being the net profit or net loss for the period. This figure will also be used in the statement of changes in equity and the balance sheet, demonstrating its important link to these statements. The Statement of Financial Position summarises assets, liabilities and equity or retained earnings of the business at a balanced date. It uses the accounting equation assets equals liabilities plus equity and is presented in statement form. The Statement of Changes in Equity summarises the change in a company's retained earnings over a specific period. It is affected by the net profit or net loss and payment of dividends and is calculated using the formula below. The closing balance of this statement will be shown as retained earnings under the equity classification in the balance sheet. The final report is the cash flow statement. It summarises all receipts and payments of cash by a business for a reporting period. They are described as the inflows and outflows of funds from its operating, investing and financing activities over a specific period. It is important to understand that the making of profits does not necessarily translate into an increase in cash funds at the end of a reporting period. The cash flow statement also validates the cash balance contained in the Statement of Financial Position. To conclude, an overall image is provided to demonstrate the connections between the 4 statements.